And hello there, it's Dr. Brenda. Welcome to How to Make Investing Decisions Based on Your Timeline. So, just the usual spiel here at the front end. This is a recording of the presentation only. I do this for three reasons. Number one is to give workshop participants all the confidentiality you need to feel free to disclose and talk about your investing issues, concerns, and that those live workshops are never recorded to maintain that confidentiality. Second reason is, hey, I'm coming at you from an RV, the RV that travels, and sometimes there are technical glitches that can disrupt this. So I try to do this when I've got a good connection, and that way you've got a clean workshop here to go through. The third reason is, hey, you might want to speed this up. I know that you won't have all the distractions. Maybe you want to double speed it, whatever it is you want to do. This keeps it again, really concise. I can give you the information so much faster. Welcome, welcome, welcome. And before we really begin, I got to get you this disclaimer. I don't know your personal financial situation. I am not a financial advisor or consultant. I am a financial coach. This is for educational purposes only, informational purposes. Don't use this information to make financial, legal, or other decisions. Okay, now, are you ready? I'm ready. Are you ready? I hope you're ready. All right, investing. Finances in general, this is so true. Like, what's stopping us from really mastering our money, taking charge of it, especially investing? It's so confusing. I have 150,000 different possibilities, so many doors. Which door do I walk through first? Am I ready to even start investing? And I'm going to make this, some of this is complicated. Absolutely. I'm going to try to simplify this the best way I can. So, are you ready? You got to take care of these four pieces first. First thing you have to do is have an emergency savings, at least $1,000. $1,000 doesn't go as far as it did even a couple of years ago, so you might want to think about pushing that number up. Retirement. If you belong to a company that contributes, provides a match, so like maybe you put in 5% of your salary, they'll match 3% or 5%. They'll match it. That's free money. Don't turn down free money. Don't turn down free money. Do contribute as much so that you get that match. Third thing, you have high interest debt. This is often credit card debt, 10% or more. Pay that off. Fourth thing you want to do is really get yourself a cushion. Look at what your expenses are for the month. Multiply that by 6, at least your base expenses. Get your short-term savings cranked up. Jobs disappear. Pandemics arise. Shit happens, guys, so get the short-term savings up. You take care of these things, then you can begin to think about investing outside of, you're going to do some investing in your retirement account, but you can begin to think about the investing package. All right. I have learned I can give you all the data, all the statistics, all the research. I'm going to do that a little bit when we talk about investing timelines. But I got to back up and talk about talk about the emotional pieces, the mental pieces that go into finances, that go into investing. I'm going to talk about risk tolerance, how tolerant you are of risk. You can't, the data is not going to persuade you if you're scared to death of investing, of losing any money. So let's talk about investing fears. And one of the first things that we have to address is what you learned about money, what you learned about investing growing up. If you're working class, you're middle class, you probably didn't learn much or anything about investing. You got your college degrees, you got your law degrees, you didn't learn anything about investing. I didn't learn anything about investing. Few of us did. So most of us are coming from a complete lack of knowledge, lack of experience. So you've got really good company here. first thing I want you to think about is, how does it make you feel when I say, hey, you know what? Let's invest some of your funds. How does it make you feel? Are you saying, yeah, I can't wait. It's about time. I've been waiting for this for a long time. Are you like, I don't know. I'll think about it. Maybe. Okay. Anxious. Like, no. I mean, maybe it makes your heartbeat speed up. You're so anxious about it. You're about to have a panic attack. Really think about what investing means to you. Where are you? Because if you're anxious, you're going to have to do a lot more work than even someone who is reluctant. And we all come from very different mindsets about investing, and a lot of it is shaped by what we saw financially, what we saw our family do with money, for instance. All right, so I talk about gender and women in particular. My workshops, everything is for women, and there are differences. There are differences, big differences in finances. I mean, first of all, we don't make as much money as the guys do. Right now, I believe it's 82 cents for every dollar that the average man makes. So women lag in terms of the income. But the research also shows a lot of differences in the way that we look at our money, the way that we invest in it. We prefer to hang on to cash. Women keep 68% of their portfolio. I see I've got a typo. I go through this thing 5 times and I still have a typo. 68% of their portfolio in cash or cash equivalents, much higher than men, which is 58%. Odd thing is, women do better. So this is from 2021, but if you look back for several years, women's portfolios with the investing portfolios do better than the men by 0.4%. That's a big difference. It really is. It doesn't sound like much, but cumulatively, you're talking about a lot of money. The reason for that, if you're curious, the reason for that is women tend to hold on to investments. So they'll make an investment, not look at it, and let it ride for a long time, 10, 20, 30 years. Men think they can outsmart the market. So they're trading. Oh, it's gone up. I ought to trade out of this, and maybe I'm going to buy some of this. All that trading makes them, you can't outsmart the market. You can't beat the market. So they're losing percentage points based on that, their tendency to trade a lot. So women have more cash, but they actually do better in investing. And probably no surprise to you, they're actually less comfortable making investment decisions. So just 34% of women feel comfortable making investment decisions compared to 49% of men. Big differences. So I don't think, we can discount that. One of the things that I talk about, and and again, I can show you the data. It may not convince you if you are really, really conservative, really afraid of investing, but I'm going to give you this data because let's say we've got three women, three young women, got $100,000 to deposit. I was like, I know, I want that problem too. Hey, $100,000, you can see what a huge difference it makes when I use that nice round number. So it's a really good visual for me. Woman one, she puts $100,000 into a low interest savings account, earns 1% annually. After 10 years, she's got $111,000. Person two puts it into what's called a TIPS, Treasury Inflation Protected Securities. It's government backed, conservative. It matches inflation. Now, inflation right now, as I'm doing this presentation, is extremely high. So those TIPS, you're going to get a higher interest because it's keeping up with inflation. Historically, in the United States, inflation runs about 3% a year. So I used a very conservative 3% here. Woman two, puts in $100,000, 3% annually. Her value is $134,000. Person three, she puts it into a stock market index, U.S. stock market index. And stocks come in all kinds of shapes, all kinds of varieties, and international tends to be higher risk than domestic, for instance. but we're going to give her an 8% average return. That's pretty normal. So she puts in $100,000. After 10 years, she's got almost $216,000. You just stop and look at those numbers. Do you want to be person one after 10 years? 111,000. Do you want to be person three? Almost $216,000. We're not talking about a couple of $100. We're talking almost twice as many dollars. Okay? So you are taking a risk by keeping all your funds in number one. And even woman number two doing the tips, that's a lot of money to be leaving in a relatively, it's low risk, but it's also low return. So you are risking your future when you play it so safe that you're not making some investments in other assets like stocks and real estate and whatever's out there. Okay. I give you the download of this PDF, and sometimes I include resources just because I think you might be interested in them. So I give you this slide as an example. It's the rule of 72. You take 72 divided by the rate of return, and that tells you how many years it's going to take to double. So 72, let's take a look at this. So she's got 1%. It's going to take her 72 years, guys, to double. That $100,000 is going to take her 72 years. Do the math. She starts at 20. In 92, it'll double. Okay, that's crazy. So compare that to our 8%. Her money doubles in 9 years. So you can see after 10 years, it's more than doubled. It's going to double again in 9 years. So after 20 years, that's going to be worth at least $500,000, at least. So the difference is dramatic. You can double your money in 72 years, or you can double your money in 9 years. Okay. So I don't know if that convinced you at all, but it's an eye-opener. You have to learn about your tendencies. And by tendencies, this is where you have your mindset, your mind is telling you one thing, and there's your action. Are you being consistent? Are you doing what you think you thought you would do? And when you invest, I mean, if you were to see maybe even a banker, a financial advisor, they're probably going to get you online or give you a risk tolerance questionnaire. And they're going to ask you questions like, okay, let's say you got $100,000, stock market drops 20%, it's down to 80,000. What do? Do you pull out? Do you stay in the market? Do you buy more? So ask you questions like that. Sounds great. Hypothetically, theoretically, realistically, no. It doesn't match. People who say they're really aggressive and maybe they're going to buy more, maybe they're going to leave it in, are some of the people who panic and freak out. So when that $100,000 goes down to 80, they sell. They've just locked in their losses. They've done the opposite of what they said they would do on that questionnaire. So just a little warning, and that's my sociological background, my social science research. It's great to have a score. If it's unreliable, it can do more damage. So the best way for you to really think about what it is you're going to do is just know your tendencies, okay? And you're going to start small. So if you are afraid of risk, just, put a little bit into a stock index or just start small so you can get a sense of how comfortable you are. Turn off the social media, all the financial gurus that tell you that the world is coming to an end and gold is going to be king and you got to buy crypto and you have to do these things. The market's just going to crash. You're going to hear that a lot. Just tune it out. Tune it out. Start small. Stick with some investments. See how you feel. Get used to making some mistakes. That's the way we learn. Make mistakes with a small bit of money. Don't make mistakes with a big pot of money. So start small. Okay. So that's the piece of looking at this emotionally and mentally and the things that hold us back, the things that we may need to overcome to begin investing. Now we're going to go into some details and we're going to try, I'm going to try not to complicate it too much. One question you need to ask yourself. Sit. It's come down to one question. When do you need the money? When do you need the money? That's going to determine how much risk you're willing to take, where you might want to and make these investments. When do you need the money? Okay. So before we continue, I want to talk about investment versus speculation. Not always a great divide between them. So an investment is an asset or item that is purchased with the hope that it will generate income or appreciate in value at some point in the future. A speculation, and yeah, I got crypto here in speculation. It's a long-term investment. It's rooted in a thesis that's not currently provable, but could become provable in the future. So it's also a speculation because it is not backed by cryptocurrencies, not backed by any government currencies. It's not backed by the government. So you lose it, you lose it. There is no other recourse. So right now, I put that into the speculation piece. I'm not really going to, I mean, that's a whole nother presentation. And I have talked about crypto before. So we're going to talk about investments, those things that have been around for a long time, and we can see the historical returns and patterns of it. This is where, don't try to write this down, guys. Don't try to write it down. I'm going to give this to you. You'll have the PDF. But this is, at least in the United States, these are some of the options we have, and I go from low risk to medium risk to high risk. I've just put some things in here, and you can, see what each one of those things means. Again, crypto I put in the definite high risk. If you're going to put anything into any of those three, be willing to lose it all. Low risk, CDs, certificates of deposits, your treasury bonds that we just talked about, the TIPS, Treasury Inflation Protected Security. Okay, all right, your eyes are rolling. You guys can look at this later, but it's low risk, medium risk. As you go into medium risk, you're going to be doing more stocks and bonds and some real estate, and then you've got these high risk items where they're very volatile. You could make a lot, you could lose a lot. It's just a huge roller coaster. So the reason you have all this information is it gives you a sense of the low, medium, and high risk and what happens with the returns. You take a high risk because your money could grow exponentially. It is a high risk. You can lose it all, but you can grow it to, you could hit the jackpot. It's like buying Amazon stock when they just sold books, when it was just brand new, right? You're talking about an investment of $1,000 that could have returned hundreds of thousands of dollars. So high risk, high return. The low risk, the savings accounts, the CDs, pretty safe, but they're not going to make enough money for you to retire off of. Low risk, low return. And then, of course, you've got your whole stuff in the middle that will give you a decent return, some risk, but not too much. So that's the way it works, guys. That's it. The lower the risk, the lower the expected return. The higher the risk, the higher the anticipated hopeful return. Okay? Asked you the question about when do you need the money? We're always going to go back to when you need the money. So this is just an example. This is not telling you that you have to buy one thing or another. And even if we're talking stocks, there's so many variations of stocks, dividend stocks, value stocks, growth stocks, international, domestic. We can't possibly get into that here, and I don't want to complicate this for you. So let's just talk about emergency funds, short-term, medium-term, and long-term. You need the funds pretty soon. Keep them safe. keep them as safe as you can. A good old savings account, best place for it. Short term, 1 to 3 years, maybe you get a CD. Again, you're hopefully making a little bit of interest off of it, but you need that money pretty quickly. I maybe a bond, maybe a tips fund if it's something that has a little bit of exposure to stocks, but it's short term. You could keep that easily in CDs and savings accounts. Medium term, now we're talking about giving your money some time to grow. So you're going to increase that risk level here. Maybe you're going to do some more bonds. REITs are real estate investment trusts. It's a way to invest in real estate without actually buying properties. But real estate has some risk associated with it as well. So that gives you an idea of how you might want to invest, looking at medium term. Long term, now you're going to get more aggressive. You're going to go for more stocks. You're going to go for maybe buying some real estate properties. You're going to take higher risks. Don't pull out when things go bad, because over time, the market goes up and it's going to come down. It's going to come up. That's the idea of taking more risks, is that you're going to eventually see those greater funds. I want to make this really simple for you, because those last couple of slides, lots of information, right? So, use this as a reference point. Think about your own level of how secure you feel about investing. Emergency fund, this is going to be easy. If you love cash, hey, fill it up. Get at least $1,000 in your emergency fund, maybe more. Short term, 1 to 3 years. Now we're talking about savings, CDs. Again, very low risk, something safe. Maybe you want to buy a new car. Your car is on its last legs, a new used car, whatever it is. You want to buy something in 1 to 3 years. You don't want to take out a giant auto loan. Whatever it is, put it down. And again, I will give you this PDF. No, easy peasy. Medium term, 4 to 9 years. Are you thinking of something? It gets more difficult. As you get out on the time frame, it gets more difficult to think about what you might do in 4 to 9 years. Maybe you want to take 6 months off and travel around the world. You want to get a little cottage by a beach. You want to buy a house. Whatever it is in the 4 to 9 years, what do you want? How much do you want for it? And how much do you have? Where is the money? Okay, where are you keeping it? Again, you can get a little bit higher risk level. Maybe you want have some stock exposure. Long term, usually you're thinking about retirement, 10 plus years. What do you want it for? How much do you want? How much do you have? Where is it? And again, when you're talking 10 years, you're going to do a lot more in terms of stocks and real estate, those types of things that are going to, over time, give you better returns. I have another presentation, which is Investing 101. That takes you through all the nuts and bolts, how to get started. Okay, so I would recommend that you look at that recorded workshop as well, Investing 101, if you want to know how to start. The best advice, and I shouldn't use the word advice, my suggestion to you is, when you think about investing, prioritize your retirement funds. Hopefully you've got a 401k, a 403b, something through your employer, an IRA, a Roth IRA. Again, Investing 101 would tell you what those things mean. But prioritize retirement funds because they've got great tax advantages here in the United States. Tax time, you're going to be happy you did that. All right, so I've covered a lot of ground here today. Questions, connect with me if you have any questions. This is the last workshop of October. I can't believe it's November right around the corner. So we did investing, overcoming your investing fears, all of October. November, we're shifting gears. And yep, I am mindful it is Black Friday. It is time to spend in November and December. I'm going to talk about mindful spending. First up, our workshop is on setting your priorities, having your priorities match your spending match your priorities. That's the way it should go. And then let's do something to avoid the holiday credit card hangover. So that's in the middle of November. Can't believe how fast time is going. In Gutsy Women Finances, don't forget, I have the Financial Freedom Academy. It will walk you through every step that you need to reach financial freedom, actually financial independence, so that you can choose to work. You don't have to work. All right. I hope you enjoyed that. You guys take care. Hop on into the next workshop. I can't wait to see you there. And hey, happy investing. Take care.